Hello everyone, this is Dr. Hessa Al-Fadhel, the course coordinator of Accounting 112. In this video, I'm going to explain Chapter 9, Part 1. The chapter title is Accounting for Receivables. Please pay attention. The first learning objective in this chapter is to apply the allowance method to account receivable. Now, before talking about allowance method, let me give you here an example to understand what is account receivable allowance method. So now let's see this example. In the 2nd of November, each company, they sell merchandise on credit for $1,000 to John Lewis. And each company, they give a credit term to the buyer, which is John Lewis. They said that if you pay within 20 days, you're going to get 3% discount. Otherwise, you need to pay within 90 days. Now, how each company will record the following entry of the sales of merchandise? Each company will say account receivable of 1,000 and the sales 1,000. Now, why account receivable? Because they did not receive the money from the customer yet. And because the company, they did credits sales. Now you have to remember that companies sometimes they suffer because not all of the customer they pay the credit, or in other words the account receivable. Therefore, the company in this case, if they did not receive the money from the customer, they record the account as uncollectible account receivable. Not of all of the customer they're a good customer, they are going to pay their account receivable. Sometimes that will take them more than even the credit term. Now here the credit term is otherwise if you didn't pay within 20 days, you need to pay with 90. Some of the customers, they don't even pay within 90 days. And some of the customers, they don't even pay their account receivables. So in this case, the company, they're going to record it as uncollectible account receivable. In accounting, to collect or to estimate the uncollectible account receivable, we have different methods. In this course, we are only going to focus on the allowance method and other different methods that you are going to see it in the other video. What is allowance method? Allowance method, at the end of each period, we're going to estimate total bad debt expected to be realized from the period of sales. And we have two advantages of this allowance method. It records the estimate bad debts expense in the period when the related sales are recorded. Second, it reports the account receivable on the balance sheet and the estimated amounts of cash to be collected. We're going to understand the allowance method more when we are going to do some of the examples in the next slide. Now we have here the allowance method, which is recording the bad debt expense. Let's read it to understand what does bad debt expense means. So we have a company here called Telecom, which has a credit sales of 300,000 during the first year of operation. So Telecom, they have credit sales. So that means that they sell and they did not receive the money yet. At the beginning of the year, it means their account receivable was 300,000. How did I know that their account receivable is 300,000? Because they did a credit sales at the beginning of the year. But at the end of the first year, we have 20,000 of credit sales remain uncollectible. So it means now my account receivable now is 20,000. How did I know that my account receivable 20,000? Because at the beginning of the year it was 300,000, but the customers keep paying me throughout the year, and when I reach to the end of the first year, my account receivable now remain 20,000. I did not collect still 20,000 from my account receivable from the customer. And they say based on the experience of the similar businesses, based on the experience of the company, Telecom, they estimate that out of the 20,000, which is the account receivable, they estimate that only 1,500 of the account receivable will not be collected. So now, at the end of the first year, I have account receivable of 20,000. But now, Telecom, they have experience in the market and they know their customers. So they estimated, so remember it's an estimation. It means that we might be right and we might be wrong. It's an estimation. So Telecom, they estimate that out of the 20,000, 1,500 of the account receivable will not be collected. So they are assuming that some of the customer will not be able to pay the account receivable, and they estimated a number of 1,500 out of the account receivable will not be collected. So now how I'm going to record the bad debt expense? Why it's a bad debt expense? Because the company is not going to collect the money. So remember, the bad debt expense, it's an estimated. How much did they estimate Telecom? They estimated 1,500. So how am I going to record the bad debt expense here? Remember, we're doing the allowance method. We're going to say here, bad debt expense, my expense is going to increase, and my allowances for doubtful account will increase. By how much? By 1,500, 1,500. What is the 1,500? If you go to the question, you will see that this is the estimated number that we assume or we estimate that is not going to be collected from the account receivable. So this is how to record the estimated bad debt expense. So they are going to tell you how much is the estimation based on the company experience. So when you're going to record it, you are going to say bad debt expense to allowances for doubtful account. What do you mean by allowances for doubtful account? It means that we doubted that we are going to receive 1,500. Because we doubt, we're going to expense it as a bad debt expense with 1,500. So now if I'm going to record here the T account, you can see that I have account receivable, and the account receivable is 20,000 on the debit side. And we have allowances for doubtful account. The allowances for doubtful account, it means that I doubt that I'm going to receive 1,500. Remember, the allowances for doubtful account normal balances credit is always going to increase on the credit side, and if it's going to decrease, it will decrease on the debit side. So how I'm going to show those accounts in my balance sheet presentation? So you remember here, we said that we have account receivable, and we know that the account receivable is part of the balance sheet. Account receivable, it's an asset, and if we are going to record it in the financial statement, I have to record it in the balance sheet. And remember, under the classified balance sheet, I have to record the account receivable under the current asset. So I'm going to record my account receivable here, 20,000. From where did I get 20,000? We already explained it in the previous example. And if you can read here the example, you will see that at the end of the first year, we have 20,000 of credit sales remain uncollected. Then, now I'm going to decrease the allowance for doubtful account. Remember, we said that we already record the bad debts expense entry. We said bad debt expense to allowances for doubtful account. Remember, the allowances for doubtful account, it's a contra account to the account receivable. What do I mean by contra account? It means that the account that will decreases the account receivable. So we say here less allowances for doubtful account because we are doubting that we are going to receive 1,500 from the customer. So I'm going to say here 1,500. Now, how much is my account receivable? It means that I'm not going to receive 20,000 from the customer. I'm going to receive only 18,500. Why only 18,500? Because yes, I do have account receivable 20,000, but I'm doubting. I have doubt that I'm going to receive 1,500. Remember this 1,500, the allowances for doubtful account and bad debt expense, those are estimated numbers. We might be right, we might be wrong. Okay, maybe now we think that the customer is not going to pay us, but later on he might pay us. So it is an estimated. So if you are estimating or you are doubtful that you're going to receive, you have to remember that the allowances for doubtful account, it is a contra account to account receivable. What do I mean by contra account? It means that the account that will decrease. So we say less. Remember why we say less? Because the allowance for doubtful account, the normal balance is credit. So it means that my account receivable, I'm not going to receive 20,000 from the customer, I'm going to receive 18,500. Now let's see here the allowance method write off a bad debt. So what do I mean by write off a bad debt? Let's see the example here. They told me here, TICCOM has determined that J. Kent's 520 account is uncollectible. So now what's the difference? In the previous example, we said bad debt expense to allowances for a doubtful account. In the previous example here, we were estimating, we're not quite sure. That's why in the previous example, we say bad debt expense to allowances for a doubtful account. We just estimated, we are doubtful, but we are not quite sure. But now, when they say writing off a bad debt, it means that now we are sure that this customer is not going to pay the money. So here in this example, they're telling me that J. Kent, he's unable to pay us 520. So this 520 is uncollectible, and we're quite sure. If you're sure that this customer in particular is not going to pay, then you need to write off the bad debt. So how you're going to record the entry? You're going to say allowances for doubtful account. You're going to close your allowances for doubtful account, and you are going to close your account receivable. Remember, when you're writing off, you're going to say allowances for doubtful account. You're going to close your allowances for doubtful account, because remember, allowances for doubtful account, it is normal balances credit. If you want to close it, you are going to take it to the debit, and you are going to close your account receivable of this customer. You're going to close the account receivable of J. Kent customer. You're going to close it on the credit side. 520, 520. Remember, writing off, when you're going to write off, it means that you're 100% sure that this customer is not going to pay. That's why you're going to close your account receivable. In the previous example, when we estimated, we say bad debt expense to allowances for a doubtful account. We did not close there in the previous example the account receivable, because we're not quite sure that the customer is not going to pay. But now we are writing off because we are 100% sure that this customer is not going to pay the accounts receivable anymore. So when we are going to write off, we're going to say allowances for a doubtful account, and you're going to close the account receivable. So you can see here the T account. I'm going to close the account receivable of 520. So I recorded 520 on the credit side, and I record for the allowances for a doubtful account 520 on the debit side. Okay. Now you have to remember, when we are writing off, it means that I'm going to close my account receivable, and I'm going to close the allowances for doubtful account for a particular customer. But you need to remember that. Let's see here, before write off, the accounts receivable was 20,000, and list the allowances for doubtful account 1,500. So we say the net account receivable is 18,500. Now, in the previous example, we said that we write off 520. So I'm going to say, okay, 520 minus 20,000, it's going to give me the account receivable after the write-off 19,480. And again, I'm going to remove 520, which is the amount that I write off and from the previous example. So it means that my allowances for doubtful account will be 980. Now remember, if I say 20,000 minus 1,500, it means that the net account receivable will be 18,500. After write-off, if I take the allowance account receivable minus the allowances after write-off, you can see that the net account receivable, it's still 18,500. So now you have to remember, the write-off does not affect the realizable value of the account receivable. even if you're going to write off, you're quite sure that this customer is you're not going to collect from him any money, you're going to record the write-off entry, but you have to remember that the net account receivable is not going to be affected before the write-off or after the write-off. Now we'll talk about the allowance method recovering a bad debt. Now, if you remember, we said that Tech Company has determined that J. Kent 520 account is uncollectible. This was the previous example. Here, we were 100% sure that J. Kent is not going to pay, or we're not going to collect the money from him. So what we did basically, we said, okay, I'm going to close his account, allowances for doubtful accounts, and I'm going to close his account receivable. So what we did basically, we write off the uncollectible account. Why we write off? When we say we write off, it means that I close his account receivable and I'm 100% sure that this customer is not going to pay me. But sometimes some of the customer, they will surprise you. You already write off, you already close his account receivable. But then on March 11, Kent, he said, hello, I'm back. And I want to pay my 520 account. Now you have a problem because you assumed on January 23 that this customer is not going to pay at all. And in January 23, what we did, we write off, we closed his account receivable. But now the customer, he just realized that he wants to pay. And he appeared back on March 11. And he said, hello everyone, this is my 520 and I'm going to pay. So what you're going to do, you're going to prepare the entry in two steps. Step 1, you're going to restate his previous write-off. In January 23, if you can see up there, we wrote account allowances for doubtful account to account receivable. So now you need to put his account receivable back. So what you're going to do, the first step in March 11, I'm going to say account receivable for allowance and allowances for doubtful account. So what I'm going to do, I'm going to reverse the write-off entry. I'm going to put back the account receivable and I'm going to put back the allowances for doubtful account with the same amount that I write off. I write off here in the January 23, I write off 520. But now I'm going to put back the account receivable. And in step 2, I receive cash of 520. My cash is going to increase. And again, I'm going to close my account receivable. So now remember, if you already write off the customer account and then the customer all of a sudden appeared and he wants to pay, you need to do the entry in 2 steps. You need first to restate his account, which means, what do I mean by restate? I'm going to take the write-off journal entry, but I'm going to reverse it. I'm going to bring the account receivable back, and I'm going to put the allowances for doubtful account back in the credit side. Then, the second entry, because the customer, he pay me, my cash is going to increase, and then I'm going to close his account receivable again. So remember, this is how we recover a bad debt using the allowance method. This is the end of Chapter 9, Part 1.